A billionaire dealmaker just raised $4.5 billion to roll up a sleepy industry. Let's break down the playbook. Brad Jacobs is the chairman and CEO of QXO, and he is targeting building products distribution. He raised $4.5 billion in total, $1 billion as a stake in a public company, plus $3.5 billion from institutional investors. He says it is the biggest single raise in the building products industry's history. The pitch is simple. Most of his backers made money with him before. They invested in his earlier companies and are betting he repeats it. So what is the Brad Jacobs playbook? Step 1 is talent. Honest, hardworking people who can debate without being a jerk. Step 2 is to move fast and be decisive. Step 3 is the M&A engine. Look at many deals at once, so you never overpay. Overpaying, he says, is the cardinal sin of M&A. Step 4 is to integrate thoroughly into one brand with real market power. And the prize is a huge fragmented market. Building products across the US and Europe is roughly an $800 billion industry. It is extremely fragmented. There is no dominant giant. Jacobs wants to build a $50 billion plus company over the next decade through larger acquisitions and more than one. The loop is simple: acquire, integrate, measure, repeat. He measures customer satisfaction, employee engagement, and on-time performance. Before QXO, he ran a filter. He studied 55 different industries to find where his playbook fits. 2 consulting firms helped build a list of about 1,000 names. That filtered to about 40 companies with $300 billion in aggregate revenue, and then down to a focused list of about a dozen. Now the problem he is attacking: the buying experience. Ask contractors to rate the industry, and they give it about a 6 out of 10. 2 complaints dominate. 1. You order 10 items. You get 6, and 4 are back-ordered. 2. You need it Tuesday. It arrives a week late, and that costs money. The root cause, he argues, is the absence of technology. His reference point is GXO, the warehouse company he spun off. It is the largest pure-play warehouse company in the world. Over 200 million square feet, about 1,000 warehouses, dozens of countries. Inside, collaborative robots, robotic arms, and software tracking every single item. That data enables demand forecasting and tighter inventory. Just enough stock, not so much it ties up cash, not so little it annoys customers. So why do not existing distributors already do this? A few do. Ferguson, Watsco, and Builders First Source are singled out by Jacobs as a theory about the rest. The industry converts about 75% of earnings into free cash flow. Low capital spending means few bankruptcies in downturns. So the industry never built a continuous improvement reflex. No lean, no Six Sigma, no daily hunt for efficiency. His edge is scale. He can spend hundreds of millions on technology. A small distributor doing hundreds of millions in revenue simply cannot. The second edge is mindset, an intense commitment to delight customers. Now the demand backdrop. U.S. housing is underbuilt by millions of units. The average American house is over 40 years old. The typical commercial building is around 50 years old. And infrastructure will need trillions in roads, bridges, and tunnels. He also screened for industries AI will not easily disrupt. His bet: in 10 years we will still sleep in physical houses with physical roofs and doors. On deals, his approach is blunt. He cold calls the owners. He pays a fair price. No trophy prices, no overpaying. Private family companies are the easiest. Private equity ones the most choreographed. Corporate carve-outs, he says, have worked well. His proudest deals came in 2015 at XPO, Conway, which put XPO into less than truckload freight, and Norbert Dentressangle, a French logistics company. The playbook in action: simplify the organization chart. Conway had 3 AT, 3 HR, 3 finance teams, 3 of everything. Strip the duplication, raise service levels, take share. On the economy, he is honest. It is hard to predict. Stimulus is inflationary. Higher rates are the brakes. The two are in tension. He holds no firm conviction on the rest of the year. On cost of capital, debt is pricier than the near zero of the last decade, so he plans to keep leverage at roughly 1 to 2 times. He keeps a clean perimeter: the US, a little Canada, and Western Europe, together, about $800 billion of market, and he wants to diversify supply chains away from China. On AI, he points to his logistics company QXO. Roughly 97% of its orders are now sourced or covered digitally. Growing, he says, at about 3 times the industry rate. Strip it down, and the playbook is 4 lines. Great people, big, specific goals. Hold people accountable. Tie pay to the outcome. Whether a $50 billion building products company actually gets built is still to be determined. Watch the deals. Read the playbook. That is your awesome update.